Welcome to Module 9 of the Business Accelerator program, Understanding the Numbers. Numbers might not be everyone's favorite part of business, but they are one of the most powerful tools we have. In fact, they're not just numbers, they're stories of your business performance. In this module, we're going to unpack how to read and work with financial data so you can make better decisions that lead to sustainable growth and profitability. You don't need to be an accountant, but you do need to understand what the numbers are telling you. Too many business owners run their business from gut feel alone. They check the bank balance, maybe glance at the profit figure once a year, and assume things are fine. But here's the truth. You can't manage what you don't measure. If you don't understand your financials, you're flying blind. And that's risky, especially in small business, where margins can be tight and one wrong move can have major consequences. In this module, we'll begin to build your financial literacy to give you the confidence to use your financials as a strategic tool. In this module, we're going to focus on three big areas. The three key financial reports every business owner must understand, the importance of managing cash flow, and how to plan and manage for growth in a way that's sustainable. So let's start with the three key reports. Accurate numbers don't lie. They tell you how you and the business have performed. You can't manage what you don't measure. You become aware of what's working and what's not. They help you track your progress, spot issues early, and make smart decisions under pressure. When you understand the numbers, you become a better leader. You gain control, and ultimately, you drive better performance. Poor performance in small business often has nothing to do with effort or talent. It partly comes down to a lack of financial insight. There are three core reports you need to be across in your business. The profit and loss statement. This shows how your business is performing over time. The balance sheet, a snapshot of what you own and owe at a point in time. And a cash flow projection. This forecasts the timing of money in and out of your business. Each one serves a different purpose, and together they give you a full picture of your financial health. Let's start with the profit and loss statement, often called the P&L. This report tells you how your business performed financially over a given period, usually a month, quarter, or year. It shows how much income you earned, what your expenses were, and what was left over, your profit. Think of it as a movie, a flowing sequence of your business's activity. It helps you understand whether your business is actually making money based on your trading performance. So why does the P&L matter? Because it shows if your business model is actually working. Are you profitable? It lets you track trends like rising expenses or shrinking margins and make changes before they become a problem. It also helps you adjust your pricing, manage costs, and decide where to invest. It's not just about reporting history, it's a tool for making smarter decisions going forward. The P&L is packed with powerful insights. Here are some key measures to focus on. Revenue. This is the total sales or income generated. Tracking this shows whether your top line is growing and whether your marketing and sales strategies are working. Gross profit. This is revenue minus the direct costs of producing and delivering your product or service. A strong gross profit margin means your delivery model is efficient. Net profit. This is what's left after operating expenses. It tells you if your business is truly profitable once all expenses are accounted for. Overheads. These are your fixed operating costs. Monitoring them helps you ensure that your expenses are in proportion to your revenue. Markup. This is how much money you charge compared to your costs. A healthy markup is essential to cover overheads and still leave a profit. Your break-even point. This tells you how much you need to sell to cover all your overhead costs. It's a crucial benchmark that every business owner should know. Wage efficiency. This looks at how much revenue or profit is generated per employee dollar. It helps track productivity and whether your team structure is profitable and sustainable. These KPIs aren't just for accountants. They're vital tools for driving smart, strategic decisions in your business. Simply put, your balance sheet is a snapshot of your business's financial position. It's at a specific point in time, and it shows three things: your assets, what you own; your liabilities, what you owe; and equity, what's left after liabilities. That is your business's net worth. A balance sheet is like a photo. It captures how strong and secure your business is financially at any moment in time. The balance sheet gives you insight into your financial strength and risks. It shows whether you can meet your short and long-term obligations and how much financial buffer you have. It also tells you whether your business can fund future growth or whether you'll need external finance, helping you plan ahead with confidence. Some of the key measures to watch in your balance sheet are the current ratio. This measures your ability to pay short-term bills, and ideally this number should be above 1.5. Debtor days. This tells how long, on average, your clients take to pay. The lower the number of days, the better. Working capital. This is the difference between your current assets and current liabilities. It's your financial breathing room. Positive working capital means you can cover short-term obligations without stress, and if the number's high enough, it can help you fund growth in the short term. The cash flow projection forecasts the timing of cash moving in and out of your business. It doesn't show if you're profitable, it tells you when money is arriving and when it needs to go out. This is critical for making sure you can cover payroll, tax, supplier payments, and growth plans without any surprises. Many businesses run into trouble, not because they're unprofitable, but because they run out of cash. A cash flow projection helps you avoid that by letting you forecast cash shortages in advance. It allows you to prepare, delay costs, speed up collections, or secure short-term funding before there's a crisis. It turns reactive panic into proactive control. Now let's clarify some of the key reasons why profit and cash aren't the same. Timing differences. You may record a sale today, but not receive payment for 30 plus days. Revenue is shown now, but cash comes later. Work in progress. If you've started work but haven't invoiced, your effort is not yet revenue or cash, but the costs may already be hitting your P&L. Loan repayments. The total repayment reduces your bank account, not your profit. The principal component is a reduction in the liability, and the interest component is an expense and hits the P&L and reduces profit. Asset purchases. Buying equipment or vehicles. These are capitalized and don't appear on the P&L immediately, but they drain your cash right away. Tax payments. Profit looks great, but then comes a tax bill. If you haven't planned for it, your cash takes a hit. And drawings. When owners take money out, it's not an expense, but it absolutely affects your bank available cash. Understanding these differences is the key to avoiding surprises. Each financial report gives you a different angle on your business. The profit and loss shows your trading performance over time. It answers, are we making money? The balance sheet shows your financial position at a specific point in time. It answers, are we financially stable? The cash flow forecast shows the timing of cash movements. It answers, can we pay the bills? Together, these give a full 360-degree view of your business health. Capacity is about how well you are using your productive resources, whether that's people, machines, or tools. You can view your business capacity as a cup. How full is it? There are 3 levels to be aware of. Maximum capacity, theoretical output if everything runs at 100%. Realistic capacity, what's achievable under normal operating conditions. Actual capacity, what are you currently achieving? This gives insight into where you might be utilizing or underutilizing resources or pushing them to the limits. Capacity tells you whether your business needs to grow or improve how it's operating. If you're close to full, it may be time to increase capacity by hiring more staff, upgrading equipment, or expanding facilities. If your capacity is under strain but not fully used, you can often improve efficiency through better training, streamlined processes, or upgraded systems, enabling you to get more done with what you already have. If you have excess capacity, it may be time to chase growth. That is, fill the cup by increasing sales and bringing more work in to take advantage of the underutilized resources. Understanding capacity helps you decide whether to scale, optimize, or go to the market harder. Here's what to remember. Understand what each report tells you. Focus on key measures, not just the raw numbers. Watch your cash. Profit doesn't pay the bills. Manage your capacity to plan for growth and use financial reports when making key decisions. Your financials are a compass. Use them. Take a moment now to reflect on the following. Is your accounting software up to date? If your data isn't current, your reports will be misleading. Make sure your bookkeeping is accurate and timely. Are you reviewing your profit and loss regularly? This helps you track progress, catch issues early, and make smart decisions with confidence. What is impacting capacity? Is it focusing on the wrong tasks, undeveloped processes, or training? Write down your thoughts and we'll address them in the workshop. So let's recap. Financial reports are not just for compliance. They each tell a critical story and they are strategic tools that aid decision making. Your profit doesn't equal cash. Tracking the right KPIs helps you stay in control. What you measure, you can manage. And you must understand capacity to plan for sustainable growth. You don't need to master accounting, just the key numbers that drive performance. Warren Buffett famously said, "Accounting is the language of business." If you can't read the scorecard, you can't tell the great decisions from the bad. And he's right. Your numbers are a scoreboard. They just don't tell you how you're doing. They should be a key consideration in every major business decision you make. Thanks for watching, and don't forget to follow our socials. We look forward to seeing you at the workshop.